Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, Alex shares his winding path from a non-target university to breaking into a top bulge bracket group at BAML in New York. Learn what made him a top-ranked analyst and how he ended up at Permira, a top private equity fund, as their first pre-MBA associate, as well as his success and failures once he hopped off the traditional path. Enjoy. All right, Alex, welcome to the Wall Street Oasis podcast.
Thanks for having me.
So it'd be great if you could just give the listeners a short summary bio.
Yeah, so I've had a eventful career. I grew up in the suburbs of Chicago, went to the University of Illinois, non-target school, was initially pre-med and, got the finance bug and started my career pretty traditional. Did investment banking at the perfect time in the global financial crisis, ended up getting a gig in large cap private equity. And then since then, it's been largely non-traditional. I was the first employee of a startup that was successful, ended up selling for 100 million, ran my own hedge fund for a number of years. And now today am at an esoteric asset firm, trading in, long dated receivables. So it's been a long journey, but it's been fun.
Sounds interesting. It's gonna be a fun one. So let's go back to University of Illinois. Why did you end up there? Was it like was it good for pre-med, or it's just like, out of high school you're like, U Chicago, forget that? What was going on there?
Yeah, I honestly, it was primarily just to save my parents money. So I have a twin and I have an older brother within a year. So within 2 years, my parents were putting 3 kids through college.
Yeah.
So we tried to be as helpful as possible. So I got into a number of schools, but given that I was pre-med, I was like, hey, it doesn't really matter. My first school, try to help out your parents, stay in state. And also I did ROTC. So I did ROTC, for a little bit, to help pay for tuition. And a number of other things, which I can kind of get into. I'm an entrepreneur at heart. But yeah, that was initially kind of University of Illinois, pre-med.
What was the tuition like in state, like 10, 15, something like that?
Yeah, somewhere at that range, but within like 6 to 9 months, I went to a few labs. I was like, this is definitely not for me. And given all the schooling that you need to kind of get into med school and all that stuff, very quickly, hit the entrepreneurial bug, finance and accounting. My parents, aunts, uncles, they all run their own businesses, so, funny enough, let's just go into business.
Like what? What types of businesses are they in?
So they ran a construction business, real estates, also managed and owned, kind of motels and hotels,
cool. Okay.
Cash flowing, businesses. And, it was a blessing because it was like basically the American dream. They immigrated to the States in the early 80s, and, built, a great lifestyle, great business. We're able to support 3 kids and, very thankful for that. Funny enough, so my freshman year of college, I did a internship called College Works Painting. I don't know if you've ever come across it.
No.
Basically, during school, you're running a college painting business.
Yes, I have heard of this. Yes. So you were like one of the top ones in the country or something? You got like 50 people to work for you?
Exactly. I was number 1 in the country.
No, you weren't. That was a total guess.
Funny enough, I think.
Did they tell that to everybody that they're all number 1 in the country? No. How many people did you have working for you? Seriously?
I probably had at some point probably 20 to 30 people working for me, but I was fortunate in the sense of where I grew up is kind of Wilmette, Skokie area, the northern suburbs of Chicago, where it's kind of wealthier just in general. So me selling paint jobs, exterior paint jobs, as like a kind of a hustler college kid, is easier than, maybe another neighborhood that wasn't as, prominent. But So my freshman year, I basically during the spring and summer, I drove 3 hours back home every single weekend to kind of cold call, hit the door, hit the doors, selling these paint jobs. And funny enough, yeah, I was number one in the country, obviously first in the state, and I got that district manager of the year award
Yeah.
for that year. But
So how much did you bring in, like profit to yourself? So how much did you guys sell, and then how much did you bring in? How much did that come back to you?
so I think I did 105, 110,000,
Hmm.
and I took home I think 30,000.
That's amazing.
Yes,
For
so that helped.
how many months of work?
Well, it started probably the winter season,
Okay.
and until the end of the summer. I worked until the last day before going back to school. So
9-ish
it
months.
was yeah, it was a decent bit.
Yeah.
But yeah, I mean, making $30,000, you have no sense of money.
Yeah.
You're kind of just doing this thing. People just love college kids painting.
Yeah.
Um, and yeah, I just kind of wild to think of, kind of back in the day.
So you did that. This is like your freshman to sophomore year?
My freshman year, so I got promoted, and then now I was a manager of managers the
Oh,
next year. And I think I ended up doing, I hired eight of my role for the year before. I think I did 300, 400,000 out
wow.
of that total. So my managers
Yeah,
did
yeah, yeah. That's amazing.
300, 400,000.
And so you, this was what your summer gig for freshman and sophomore year.
It was
And
my summer
during all this,
gig.
now the world is melting, right? Financial crisis. People are not ordering as many paint jobs.
No. Well, I started my career at the start of the financial
Oh,
crisis.
sorry.
So
Yeah. So
this is
this was in the booming times. Everyone's like, yeah, how much do you want for a paint? Yeah,
paid
5,000.
jobs, college kids, might as well.
Yeah.
So things are great. I did that. So I did that for the painting stuff for 2 years. My junior year, I decided, hey, wanted to kind of get into finance. At this point, I was double majoring in finance and accounting.
Mm-hmm.
So wanted to do something more related.
Yeah.
I did an internship, I think, at J.P. Morgan, not banking, but more kind of I think transaction or operations, some sort of mix.
Like a middle office
Um,
gig or something like that.
yeah,
How did you even get that, through on-campus recruiting or what?
traditional kind of on campus recruiting. I think just having the story of running, painting is
Yeah.
just unique enough where I got a decent amount of interviews,
Mm-hmm.
and then just wanted to kind of
He's a
pick, the
hustler. He's
biggest
a
bang.
hustler. He's a hustler. Yeah, get him. Yep.
He's a hustler. Yeah, I mean it's just unique. He drove home every weekend, 3 hours just to sell paint jobs. So that was unique enough where it got me in the door.
Yep.
I think from there you just have to refine your messaging. You have to do your homework and really resonate and develop rapport with who you're interviewing with. And at that point, I had an idea of kind of what I wanted to do. Like, I had upperclassmen that were getting into investment banking, and I didn't know what it was, but it was the hardest thing to get into. So you're reading vault guides and printing reviews and all these different things. But I was trying to, stepping stone. Maybe I'll start in the middle office. So did that junior year, and then because I did two majors, I took 4.5. So I was able to get another internship, I guess, my quasi senior year at B of A Merrill in bank. I guess at this point, B of A,
Yeah.
just B of A, and was lucky enough, to network myself network with a bunch of alumni and upperclassmen, that helped kind of show me the ropes of
Mm-hmm.
how to interview at investment banks, or this is what they're looking for, the quasi stock answers, or this is what you need to do, information sessions and stuff like that. And
Yeah.
was lucky enough to get an internship at B of A in their Chicago office, for I think TNT.
And that was banking. That was full on banking internship, front office.
That was full on, banking
Tell me about that
internship.
summer. Was it nuts? Was it hard? This is like this is
That's
after your senior year, basically. This is like because you had half a year because you were doing two majors, right? So, which was
yeah.
kind of a blessing because you got that second crack at recruiting.
Yeah. I got the second crack, and it was a tale of two different summers.
Yeah.
So this is 2007 when the first half of the summer was deals were going left and right. I was on 3 or 4 deals. I had my BlackBerry back in the day,
Yeah.
and people were like, the times will never end. And this is, and then the second half of the summer, it was the liquidity crunch, the credit crunch.
Mm-hmm.
All of a sudden, every single deal just died. And you're working all these interesting things, but everything kind of died. But it was a blessing in disguise because I was able to get an internship in order to leverage that to do a full-time role. Because let's say I was a couple years later, and that was 2008, 2009, it would have been so much more difficult to get a full-time role.
Yeah.
So thankfully enough, I did well. I was a top analyst in the summer analyst class.
Summer 07.
And summer of 07 was able to leverage that to the top group in New York. And that was key for me because TMT Chicago, I mean, great, right? But, starting out your career, you want to do as much as you can to get to New York.
Yeah.
So it was an interesting conversation. The TMT group really wanted me to stay in, the group and also Chicago, but I had my sights set on getting out to New York and was able to kind of finagle my way.
That's a tough thing. First off, how did you become a top ranked analyst? Were you just sleeping at the desk the whole summer, like on those, at least the first half of the summer, like just doing whatever it took? What do you think? Why were you considered one of the best versus the other interns?
Yeah, I think I was just faster to pick up some of the modeling aspects of the role.
Mm-hmm.
And then just a higher attention to detail to some of the stupid formatting stuff. Like it sounds dumb, but having everything look correct and buttoned up just gives a connotation that everything is right.
Mm-hmm.
So for better or worse, like if you're a good formatter or you're fast on the model, it
builds confidence.
It builds confidence. It presents well. I don't think I was that much smarter or anything like that, or I knew finance better. I think I was just lucky enough to have the right experiences and the right people above me to kind of vouch for, hey, we should give this analyst, this summer analyst, a little bit more responsibility and see what he can do with it.
Oh, that's cool. That's great. So you basically got the full-time offer, clearly, near the end of the summer. And they pay you pretty well as an intern, right? Did you get overtime then or no?
That's exactly correct. That was that summer. They gave us
crazy overtime. I remember this.
We got paid by hour. It was crazy. And
you made like 50 grand in the summer or something like that.
I think I made something along those lines, where I made maybe 30 grand my freshman year in painting, but this was more than that. And I was like, I'm tracking every single hour that I'm doing everything because, it's crazy to me because you're working maybe 60, 80 plus hours and they're paying you per hour.
Yeah.
Which is wild to me.
Yeah, it's nuts. So, okay. So you get the full-time offer. Is it an immediate, yes, I accept? Or are you thinking at this point, hey, you know what? I was able to get to New York, or I guess I was able to finagle, or did you say, hey, if you give me the New York offer, I'm in, I'm going to take it. Was that kind of your bargaining chips that you put in there, or how did you do it?
Yeah. I tried to leverage that offer to get to other banks. Mm-hmm. At that point, though, it was a little bit more difficult to get full-time roles.
Things were cracking.
Things were starting to, kind of crack where it wasn't like people, rescinded offers or anything like that, but you could definitely tell, because Illinois is a non-target school, we place a certain number of kids each year.
Yeah.
You start to get a sense of, okay, maybe it's only a couple into New York or a couple into Chicago.
Yeah.
I think there was only 5 Illinois kids that made it to New York that year. And then next year, 2008, 2009, there's 0, right? So you could get a sense that things were starting to shift a bit.
So you just said, okay, I'm going to take it. You accepted. Tell me about your senior year, kind of how you saw, or I guess not your senior year, it was kind of your last semester, how you started seeing things unfold.
Yeah. So my last semester.
You're trying to finish up your classes and the whole world's falling apart.
well, no, I guess
right?
it's
Wait,
the
no.
year after.
Oh, no,
It's the
sorry.
year
Oh
after.
seven. Okay. So you're still, but it was still kind of like, did you get nervous at all? Like in that, I guess it was fall '07. So not yet.
So not yet. It was Q4 of 2008 when things really
Yes.
started to hit the
Yeah.
fan. And I was at my job for probably 3 or 4 months at that point.
But what did you do for the
Um,
6 months that you were off, say between, because you finished in the winter, right? So what did you do?
yeah.
Travel?
So I didn't travel. I actually stayed on campus, hung out with friends, and just enjoyed the 6 months. I got paid per hour by B of A. So I had a great last semester. Whether it be just you know do lifting or staying working out every day or
Yeah.
doing a variety of different things. It was a great semester.
That's awesome. Okay. So you start full time. It's, I'm sure, kind of a lot of work. Was it a lot harder than the internship, or did you feel like you were ready? You kind of, obviously you were really busy at the beginning of the internship, like you said. So was it similar to that, or was it worse?
It was you could tell that things had notched up a level. Like
Yeah.
you're in New York, you're at kind of a top group where the deal flow. We're
What
in the
was that?
healthcare group,
What was that? Oh, healthcare. Okay. Yeah.
healthcare at B of A,
Yeah.
and there was constantly deals going on.
Yeah.
Whether we had we had great bankers. So and then you're kind of thrown into a larger analyst class where there's only a couple of people at B of A Chicago.
Yeah.
Now you have an analyst class like 10 plus, and you're all just trying to feel each other out. You're all in the same bullpen. You all enjoy each other, but at the same time, we're kind of like, this is my competition. Um, and then within like I think the first couple of months, you're just super green. You're super green. You want to digest as much as possible. You're living this banker lifestyle. And then, 6 months, kind of in, Bear Stearns is gone. Lehman Brothers is now bankrupt. I was at B of A and we had just acquired, and then we eventually acquired Merrill Lynch.
Hmm.
So all these things that you read in the newspapers, it was like actually happened live. And we were investment bankers, and you don't realize you're working on these big deals, but it has like real consequences to people, right?
Yeah.
You kind of forget to realize that, where we had acquired Merrill Lynch, and then both organizations were kind of merging together. Different cultures, you had different core competencies.
Yeah.
You were all kind of, navigating each other. There was definitely layoffs. So it was just a really weird time, and you just want to also have a job, right? A little bit of a tangent. So I played a ton of poker while I was in college,
Hmm.
and I very briefly thought, hey, I'm going to quit this investment banking thing. I'm going to be a professional poker player. So good thing it didn't turn out that way. But I played in a handful of kind of the World Series of poker events, and I thought I was going to be this hot shot. But better heads prevailed, and I decided to stick with finance.
So how close did you get to quitting and doing that?
Pretty close. I think within the first
You played a lot
year.
in college too?
I played a lot in college. I played me and my twin. We both played in the main event. We were 21, and
Nice.
we thought, hey, we're going to be the youngest main event winners
How did you do?
ever.
How did you do?
I was terrible.
Terrible. You knocked out. Yeah.
No. So I got knocked out the first day, but
Yeah.
I had a bracelet winner at my table, and I was like this 21-year-old hot shot that thinks, hey, I'm just going to run him over. And
Yeah.
he was literally playing poker without even looking at the cards. He was
Yeah.
destroying people. And I didn't last very long. And that was a very quick, humble pie for me. But, I think that was part of the reason why too. I was like, you're probably not as good at poker as you think you are. So
That's funny. Well, I was a co-president of the poker club at Wharton, so I know I played a lot in my day. So we could talk a lot about it, I'm sure. I don't know if we want to turn this into the poker episode today, but so yeah, tell me about like the transition from banking to mega fund PE, and when it sounds like at B of A you were actually, even in the crisis years, you still got a bonus, like you still got paid well. Is it because they separated that out for people actually doing big deals still, or because healthcare was still kind of going on? Is that how it worked out, or was it like more the whole pool got something? Because I think we talked offline before, like you were still getting what, 70% of your base as a bonus, or
Yeah,
something?
70% of my base.
Which in '09,
granted, I think big.
it's pretty good.
Yeah, um, yeah, I think bankers are getting paid a lot more, potentially these days. But I think it was in the range probably of 150 all in, somewhere in that range. I think in top bucket analysts got, maybe 50 to 55, 60,
Yep.
For a bonus. But yeah, I think it was partly the group. We were still doing deals, even during, that first couple of years. And I was lucky enough to work on one of the largest, healthcare deals that year. So, um, but yeah, kind of coming out of banking, it wasn't like recruiting now. And thankfully it wasn't, because I was a non-targeted school.
Yeah.
I, had great GPA, kind of a decent resume, yada, yada, yada. But it was a lot easier to recruit given that I had a full year under my belt.
Yeah.
And I could say, hey,
Good
I'm
deals.
the top bucket analyst. I did this deal. This is my bonus, versus now you're recruiting within a couple of months. And it's just really hard to know who is good versus not. Granted, now there's so much information available. These kids are so much better
I can
prepared
tell you a lot of people
for
purchase their private
banking or
equity. A lot of people purchase their private equity interview course. So I know people are prepared because they're drilling, so like we see the
yeah.
usage, they're doing the paper LBOs, they're doing the full blown LBO modeling test, the cases, they know. Like it's not like when I was recruiting for private equity, it was like my buddy was like, you should go to private equity. I'm like, what's private equity? He's like, here, read this deck on LBOs. Like it was literally like that. And I ended up getting a job. So this was even before your time, but I'm sure by the time you came around, it was leaving a little bit better. And then now it's just everywhere. Now everyone has to be ready, and they have to be ready earlier. Right. So yes, I think this year they're going to get out of training and be hit up right. Like they're not even going to, they might even get out of training. They might be like, hey, during training on this weekend, you have to come do these interviews because the cocktail hours are getting set up.
It's unbelievable.
Yeah.
And I think it's extremely tough too, especially if you're not from a non-target, if you're from a non-target school.
Oh yeah.
It's obviously easier if you have a pedigree school, great GPA, you're at the top of your class. And yeah, every single candidate these days, I talked to a number of alumni and they're already asking me before they start their banking internship if they should do private equity or hedge funds. So it's, I don't envy how competitive it is these days. And, thankfully, I kind of slipped through the cracks.
No, I don't think so. But yeah, so tell me a little bit about just that whole process. So it was easier. You had a full year under your belt. You had the deal, the couple big deals on your resume. So that was easier. But were you talking to like the traditional recruiters out there, the SGs of the world, the CPIs, the whatnot, and just getting into a couple processes? And then tell me about, was it on cycle? I assume it's on cycle. What on cycle was back then? Tell me a little bit about that process. I think people like to hear those war stories.
Yes. So it was on cycle was actually the summer after your first year. So you had a full year under your belt.
Yeah.
Traditional recruiters, the SG, CPIs of the world, you're meeting them probably Q4 of that first year, Q1. And at that point, also, you just don't know what the world's going to look like, to be honest. You're just thankful you didn't get laid off.
Yeah.
And also the recruiters, to be honest, too, they didn't know what private equity firms were hiring or weren't hiring. But, part of their job is also just to talk to everybody. So, I'm sure everyone knows this, but take those recruiter interviews very seriously. They are the first, kind of gatekeepers.
Yeah.
They've seen 1,000 kids across the entire analyst class. So you have to figure out a way to separate yourself or build rapport, or point to a certain experience or whatever it may be. To kind of separate yourself from everybody else.
How did you do that?
Yeah, I think it's partly, maybe
Just kept pointing to the big deals.
The big deals, top analysts, poker, twin, college works painting, just a variety of different experiences, but I think I always try to, demonstrate that, one, I was a hard worker, but also if given an opportunity that I would, prove out, my capabilities. But went through the typical on-cycle process, didn't necessarily have a ton of interviews with mega funds, but interview with a ton of Chicago private equity firms because I'm from Chicago, and middle market private equity firms, a couple of large caps, but I think ultimately it came down to a reference, from I think an associate or VP that knew the guys at Permira very well. And Permira was just starting to kind of build out their US practice. It's a large cap, global fund. But at that point, I was recruiting to be the only pre-MBA associate in the New York office.
Oh, wow.
So there's two co-heads, one in New York and one in London. And it was almost like the perfect role. Just truly blessed. I think I literally counted the number of interviews. I interviewed at 22 firms, and this was the 22nd firm.
Wow.
Yeah.
So wait, what was happening with the 21st other ones? Were you getting offers, or just you never got an offer?
I think I got one offer that I turned down, but the rest of them, for a variety of different reasons, it just never kind of worked out.
You weren't ready on the paper LBO? What was going on? No, did you ever make it to final rounds? And tell me a little bit more about that, because that's surprising from a guy who has, the non-target, but you had the strong resume at that point, and you speak well. So what was going on in terms of that? Do you looking back, or is there something you're like, oh, I should have done that to prep better?
Yeah, I think looking back, I should probably have taken interviews more seriously. I took the GTCR Madison Dearborn interviews extremely serious, because I always thought, hey, after 2 years, I'm going back to Chicago. And then all of a sudden, you're doing 10 interviews and within a couple of weeks, that it's very easy to, even though kind of they're less brand name type firms, they're still extremely interesting opportunities that you wouldn't think of.
Yeah.
And I probably didn't take them serious enough, where I was like, hey, I'm going to get one of these.
One of them will drop, and then none of them dropped.
Get enough pedigree. And then,
did you feel like you had that very typical 24-year-old or 23-year-old mentality? You're like, I got this. You're the hot shot poker. You're coming from a non-target, you get the chip in your shoulder. Yeah, but look at me, I'm top ranked. Do you think you had a little bit of that came across maybe as a 24-year-old?
Yeah, no, absolutely.
Yeah.
And you get served up humble pie pretty quick.
Yeah.
Where I thought, hey, they should know that I'm a top fucking analyst. I've done, these experiences. You can check all my references. But culture does matter. And, I think people really do, they can tell if you're doing the homework or you're just going through the motions. And, whether it be a lower middle market or middle market or large cap private equity firm, these are all extremely successful individuals that all have their interesting stories that you can tap into and you can learn from. And I probably didn't take it serious enough. And then you're doing so many interviews so quickly that you kind of get past it, oh shoot,
it's gone.
I've gone through 15 of these. What is going on?
Yeah.
But extremely fortunate and blessed that, Permira was the perfect role for me.
That's awesome.
And from a culture standpoint, being only a pre-MBA associate in the New York office. And,
was that lonely though? Was that lonely, or did you have a post MBA right there, a couple of them above you to help?
Yeah, you had post MBA associates, and they're just starting to kind of build out that practice.
Yeah.
And then, joined on, and it was like drinking from a fire hose. I did more. I did more all-nighters in private equity than I did in
really?
than I did in banking.
Wow.
And
because so many deals, you're trying to get so many deals done in that time frame, or?
Yeah. So this was now 2010.
Yeah.
We were just starting to get out of the financial crisis, and now deal flow was pedal to the metal.
Yeah.
And you're a journalist in the New York office. So I worked on a tech deal, an educational technology deal. I worked on um, a logistics company, especially rental company. So very different business models, very different sectors. And yeah, very quickly they had to hire a couple of pre-MBA associates because I was just drowning.
Yeah.
But it was working with extremely bright people. And I think what was unique about Premier too is that you really understood like the global aspect of the business because you were constantly on conference calls with your different offices, whether it be in Asia, whether it be in London, uh, Germany. We had offsites every 6 months, so that was a ton of fun. Where it's kind of work hard, play hard a bit.
Yeah.
But yeah.
So, and then how was the pay?
Days.
It was a big pay raise, obviously, but can you give a range for the listeners so they know how much it jumped?
Yes, I'm not sure what associates are getting paid these days, but yeah, I think it was
a lot.
A lot.
Yeah.
But it was almost double what I had paid
your second
back at banking. Yeah.
So we're talking like 300-ish plus 350.
A little less than 300.
A little less than 300, yes, which is pretty good for a PE, but you were working hard for it.
I was definitely working hard for it. Yeah.
And then so you're kind of you're approaching, let's say you're 2 years in as a pre-MBA associate. Are they giving you signals like, hey, you need to go get an MBA? Are they giving you signals like, what's your thought process? Do they want to keep you on? Why not stay on and get a direct promote? I know those were less common back then. So yeah, just tell the listeners, what was your thought process as you're like going into year 2, year 3 there?
Yeah. So at Permira in the New York office, everybody had gone to business school.
Yeah.
Everyone was a post-MBA associate and I think the vast majority of them went to Harvard. So it was pretty, I would say set in stone, but it was generally, if you want to come back, you would have to go to business school and come back the traditional route. That said, Premier has grown significantly over the last 10 to 15 years. I don't think that's necessarily the case today. Yeah. And to be frank, after I think I stayed 2.5 years at Permira, I was just burnt out. I was toast. Now, kind of 4 to 5 years to my career, I made a decent money, and I was just extremely burnt out. Like it doesn't matter kind of what deal flow it was. I saw a ton, and also, I think I knew I needed to do something else. So I didn't even explore the route of going to B school too much. I already knew, I was going to do something else, whether it be more on the public side of things or something kind of completely different.
So you're interviewing at hedge funds and stuff like that at that point?
I was interviewing at hedge funds. I don't think I interviewed at any private equity firms. I think it was either hedge funds. I think it was primarily hedge funds, to be honest.
Like traditional long short, what were you thinking of doing?
Yeah, traditional long shorts. I was also looking at a lot of these platforms, the Citadels, Millenniums, .72s of the world. And I was just trying to explore kind of what was out there, getting as much information as possible. I think whether you're in private equity or whether you're at hedge funds, there's pros and cons to each of those types of roles, right? I think private equity, you probably have a little bit more stability. The transaction environment is very different. It also really depends on, the investment framework of the firm, like investment committees. What is that process like? That could vary substantially depending on what type of firm you're at. Yeah. Versus, maybe at a hedge fund, it's more structured of kind of work-life balance. So you're always kind of working, but if the markets aren't open, the markets aren't open. But also the volatility of your career can obviously change very quickly as well. There's very highs, there's very lows, for a number of different reasons. Yeah. We could probably get into it later.
I'd agree with that. Yeah, I think most people would agree with that. So so you're interviewing at all these hedge funds, kind of 2 years in. Any offers from any of these or no?
I was about to join Citadel, and got to the last final interview, and for whatever reason it didn't work out. Maybe a personality test. I didn't check the box, and some some aspect of my personality. Um, but at the same time, I was I spoke. I had spoken to a friend of mine who was in banking. We were in the same class. Joined a hedge fund, one of the few hedge funds that was in the big short. They shorted a bunch of banks and they kind of held on to that short way too long. And they were exploring a startup and kind of pitched me on the idea. I've always been kind of contrarian entrepreneur at heart. You know, I was like, hey, I kind of have enough in the bank. Maybe why don't I just give this a shot and kind of see where this goes?
Mm-hmm.
And me and two of the founders, both of them were at the hedge fund. We ended up, starting a company, and we're at an incubator, completely different um, shift in lifestyle. Um, Absolutely building something from 0 to 1.
Mm-hmm.
We had started off building out financial content for high finance interviews. Similar to kind of what Wall Street Oasis does. Content along those lines. We had pivoted a number of different times, and we ended up choosing a recruiting platform for high turnover positions. And it was. I think initially, I didn't know if this was the right role to choose, kind of next. But at the same time, I also thought of it as this is probably my B school. As my B school, I can do it with a couple of buddies. Not necessarily get the brand name of a Harvard or Wharton or Stanford,
Yeah.
but I can learn the ropes as an operator and see the business. And it was fun. It was fun. Building something completely from scratch. Having the autonomy, the ownership, and responsibility. And we were just kind of hacking things. Just hacking things along for a couple of years, and seeing some traction, um, and yeah, you know, hindsight's always 2020. But I probably should have stayed a couple more years until they exited for 9 figures. But that's probably another story as well.
So was it when so as you're kind of, as it's growing, as it's kind of getting up, there's probably some funding in between the acquisition. And then was it something where like you felt like there wasn't enough traction kind of started? It wasn't going accelerating fast enough. You felt like the odds of it like surviving were just lower than what you wanted to see at that point, or or was it more like, hey, it's been 3 years, I need to do something new? Even though I assume you're doing everything, because if you're one of the first employees, you're like you end up doing everything.
Yeah. So I was one of the first employees, and kind of 3 years in, I was now a quasi CFO, COO, whatever that is. Basically, everyone's doing everything.
Yeah.
So you have this kind of title, but we're now at I think 20 to 30 people,
Mm-hmm.
and we were just about to raise our Series A, and we were kind of in the midst of it. And I was at kind of another point where if we're going to raise this Series A, I'm probably going to be committed to Vettery for another 3 to 6, 5+ years. And is this something that I feel passionate about? And to be fair, it wasn't my baby. Even though I was a first employee, I'm not a founder. Right? So I didn't necessarily have the pressures of being a founder and raising real capital from your family and friends, and having that kind of pressure, and getting close to maybe it being a zero, maybe it being a donut. So I had a new appreciation once I actually started my own fund, but it wasn't my baby. And we probably had differences in whether it be strategy or a variety of different things, and vision. And at that point, there are probably too many cooks in the kitchen as it is.
Yeah. So personality at the top, and there's three or four of you guys, like with the executives, right? So I can see that being tough. Yeah. So you guys, so it was kind of like, hey, it's time. It's run its course for me.
it's time. It's run its course. I'm not going to be married to the business for another 5 years.
Yeah.
And
which is super common, by the way. Like it's so rare for like the founding group to stick together more than like as long as the 3 years. 3 to 5 years tends to be what it, I feel like, ends up being.
Yeah.
Okay, this is better for me.
Hindsight's always 2020, but they sold for a big number, and they also spun, that experience into starting an EV toll business, which got de-SPACed for billions of dollars. So
what?
Hindsight's always 2020. I've look at that journey, and I still don't regret it because yes, I would be probably worth a lot more on paper if I kind of stuck around.
Yeah.
But I've learned a ton, and you embrace the journey. Your life's not always in a straight line.
So before you got to go, talk to me a little bit about the volatility hedge fund that you created or founded, and then Parallaxes as well. I know we only have about 10 minutes, so I want to make sure we hit those two. So real quick, so you're like, hey, I'm not going to do this startup anymore, so I'm going to start a hedge fund. Like, how did you go with that? Like, not many people are like, hey, I'm just going to start a hedge fund. So how did you get any sort of seed capital for that? Friends and family? Like, how did you do it?
Yeah. So funny thing enough, back when I was in private equity, I had barely any time to invest. I was always an investor, but I knew that I had no ability to pick fundamental stocks, given that guys on the public market side were spending days and days on one stock, doing channel checks, speaking to management. So I would never have an edge there. But I always had a kind of a knack for just data and data analytics, and using these days it's called kind of quantum mental, but finding patterns through numbers. And it was just kind of like a random hobby or interest. But I started trading in volatility. And volatility, kind of blew up during those days. I don't know if some of these volatility ETFs and ETNs like XIV or UVXY and all these. Long story short, a hobby became kind of a passion, and then a passion became a business. Because a number of my friends kind of reached out to me and knew I'd kind of do this on the side. It's like, hey, this is like really interesting. I need something to diversify my exposure. I would seed you money, to kind of start this strategy. So I started the strategy. If I were to kind of do it again, I would definitely do it with a co-founder. Given that a hedge fund, it's just a rat race. You're constantly raising capital. You have investor gates. You have month-to-month marks.
So
a large part of my job was actually spending most of my time not doing investment work and doing non-investment work, which was, kind of a struggle. So, and also, to be honest, it never got to scale where it really mattered. In order to take a large anchor, you had to give up a number of economics and kind of an arm and a leg. And there was definitely first loss capital and some other ideas. But, I, once again, kind of a couple years in, didn't see it as a long-term business. I thought just the active hedge fund business was basically all kind of gathering at a lot of these large platforms that had the infrastructure and resources to kind of outcompete maybe an emerging manager. And to use a tech term, I didn't have product market fit. It was an interesting strategy, but institutional investors that understood it couldn't invest, because there's a capacity constrained strategy, and maybe retail or family offices, they didn't understand it, but they could write some of the interesting checks.
So what's the most you were managing at that time? Like, we're talking like 5 million, 20 million, like what were you doing at that one point?
Yeah, less than 20 million. Less than 20 million, somewhere in that range. But
yeah. Okay.
A couple of years in, me and one of my buddies who I went to school with was also starting a fund. So we were always kind of bouncing ideas with each other.
Yeah.
Of how to raise capital, how to do all these different things. And he was raising a long-term capital strategy, building out this very kind of niche strategy that I was like, hey, it sounds interesting. Didn't think much of it. But a couple of years in, he was starting to get real traction, raising money. And I saw kind of writing on the wall of, just a public markets fund versus long-term capital building on a market where you have structural advantages, I was like, hey, maybe I should pitch, my horse to somebody else, So I ended up joining him at Parallax Capital. And, basically we're building on a market for a very esoteric area. We're kind of purchasing, long dated receivables from private equity sponsors that may be forced or motivated to sell once they get to the end of their fund lives. So we had found kind of this interesting niche of tax receivables that we wanted to build a market for. And, now kind of 4 or 5 years in,
you're saying receivables from the portfolio companies of these funds?
Yeah.
So you're fronting them capital to purchase these receivables at obviously a discount. So to give them some liquidity.
Yes. So the private equity fund, let's say Blackstone, they acquire a company. Mm-hmm. They obviously value creation, take the company public over a couple of years, or maybe 4 or 5 years. And 2 to 3 years later, now they've sold out the equity. But based off of unique kind of tax structuring, they've created this long dated receivable for a private equity sponsor has found money. But now let's say you have sold out all of the equity. Now you have this small non-core position that still has another 10 to 15 years of life. And then you kind of have to figure out, what do I do with this asset? Do I do a continuation fund? And LPs are, please do not send me K1s for this 2008 vintage on this small asset that we don't care about.
Yeah.
Please wind it down. And that's kind of where we come into play, where we'll purchase these assets based off of the net present value. And sometimes it ranges. But 10 cents, 40 cents, 50 cents on the dollar. Mm-hmm. And we hold them to maturity. So there's a duration mismatch where we're able to have a different perspective based off of our
and you set up processes in order to be able to do all the K1s and all that stuff. All that stuff you don't have to do it.
Well, we don't have to do it all, because now XYZ private equity firm just winds down the fund. We purchase it from them. Now it's a part of our funds. Yeah. But we have
you don't have
structures of vehicles.
You have LPs or no?
Yeah. So typical kind of private equity type vehicles. We have 4 vehicles that raised $250 million. We're actually in the process of raising our 5th vehicle. And things have slowly gotten easier. Yeah. I think it's, back at Vettery, taking something from 0 to 1, here at Parallaxis, also taking something from 0 to 1, where 0 to 1 was extremely tough. Like, how can you even do a deal? Yeah. And now, taking 1 to 5, it's been slowly getting easier.
Yeah. Tell me, how do you see this alongside the boom in secondaries? And you're providing liquidity. Do you see yourself as almost like another option? Tell me about that. Tell me about how the interplay there.
Yeah, it's another area of the market. I think secondary private equity firms.
You're kind of providing the same service, right? In a way, but just maybe on a small. You're helping clean up the stuff for the private equity fund versus like larger offloading. Should I think of it that way? Like private equity secondaries are like larger offloading of larger positions versus you guys are more cleaning up like the smaller receivable bits.
Yeah, well, you do have both, right? Yeah. So you have like GP leds where you do need to close down one vehicle and start another vehicle. I would say the vast majority of private equity secondaries, you're buying from a pension fund or a large endowment that needs to rejigger their allocation. Yeah. And I need to sell XYZ mega fund and all 3 of these funds because I need to get my allocation down to X. So it's a different exercise, but the concept is largely the same. You can purchase assets from a motivated seller at kind of like a discount, and I would say our assets are just very niche because it's just these tax receivables. Mm-hmm. But yeah, the concept is largely the same.
That's super interesting. Super interesting. So, do you feel like at Parallaxis, you guys are raising a larger fund? Do you feel like it is scalable? Where like there's enough out there that you could put to work $1 billion if you had it?
Yeah, maybe not today, but I think definitely for sure. We're on a pace where we can deploy at least 100 million a year, and we've at this point kind of transacted with some of the largest sponsors out there.
Mhm.
So it's now just increased adoption, but also like an increased addressable market, similar to secondaries. Once more and more allocators invest in private equity firms, there's going to be more and more of these allocations and more people looking to sell.
Yeah.
So we think I think we have an interesting position in the market. We're a first mover, and I think there's going to be advantages to being first to scale. So
For sure. That's
we'll
super
see.
exciting, man. Congrats on the success.
No, appreciate it. It's been a journey. I think my parents would have preferred me just be a doctor, or me go to Harvard Business School and keep it safe. But my journey has been kind of non-traditional. At the same time, it's been enjoyable. I think I've learned a lot from each aspect of the business, or each aspect of my journey, and it's been a ton of fun.
Any final thoughts, looking back, kind of any advice you'd give to people listening based on your journey?
Yeah, I wouldn't say based off of my journey, but I think given the current market environment, it's obviously not as easy as it was over the last 10 years. I think just take comfort that there's always going to be new opportunities. Always going to be new opportunities. Whether it be AI, or whether it be it's so much easier to create a business, or create content, leverage so many different things that even though the job market might be a little bit tougher, just don't feel like you need to follow one specific path. There'll be plenty of opportunities. The great thing about this market, it's always adapting and always changing. So,
love it, Alex. Thanks so much for taking the time to speak with us,
Patrick. Appreciate it.
Awesome.
Always enjoyed Wall Street Oasis.
Appreciate that. Talk soon. And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick at wallstreetoasis.com. Until next time.